The Reserve Bank of New Zealand has just delivered its final rate cut of the year, 25 basis points to 2.25%, the lowest level since mid-2022. That's 325 basis points of cuts since August 2024. But here's what's caught everyone off guard. Governor Christian Hawkesby just signaled this easing cycle is essentially over. If you're a property buyer waiting on the sidelines, thinking rates will keep falling and houses will get cheaper, you need to hear this. The New Zealand dollar jumped 1% immediately after the announcement. Two-year interest rate swaps shot up 8 basis points, and the market went from pricing in a 50% chance of another cut to just 22% overnight. Think about what that means. Just weeks ago, the Reserve Bank delivered a surprise 50 basis point cut in October, the biggest single reduction in this easing cycle. Markets were expecting the door to stay wide open for more cuts, but that door has just been slammed shut. The RBNZ's forward guidance now shows the official cash rate sitting at 2.20% in the first quarter of 2026, barely any movement from where we are now. By the end of 2026, just 2.65%. That's a hawkish tilt if there ever was one. Finance Minister Nicola Willis is celebrating, saying the rate cut is good news for growth, jobs and investment. Prime Minister Christopher Luxon, whose popularity has taken a sharp hit as the economic recovery he campaigned on has failed to materialise. But here's the critical question for property buyers. If this is as low as rates are going, and house prices are still down 17% nationally from their peak, is now the time to buy? Or should you wait for prices to fall further? The RBNZ expects inflation to slow to 2.1% by the third quarter of next year and hit their 2% target a year later. They're forecasting economic growth will accelerate in 2026, an annual average of 2.8% in the 12 months through March 2027, up from just 0.5% in the period through March 2026. Economic activity was weak over mid-2025, the bank says. But it's picking up. Lower interest rates are encouraging household spending. The labour market is stabilising. The exchange rate has fallen, supporting exporters' incomes. Doug Steele, senior economist at Bank of New Zealand, puts it bluntly. The hurdle to further action does look significant. The main message appears to be that it is highly likely the easing cycle is done. If you're a property buyer, this changes everything. Welcome to Kiwi Property Reports. I'm bringing you urgent analysis of the Reserve Bank's November rate decision and what it means for New Zealand property buyers heading into 2026. This isn't just another rate cut announcement. This is potentially the inflection point where the monetary policy cycle shifts from stimulus to stability, and where property market dynamics could fundamentally change. Today we're going to unpack 3 critical elements. First, exactly what the RBNZ announced and why markets reacted so strongly. Second, the journey that got us here, from aggressive 50 basis point cuts to this final 25 basis point reduction and hawkish signal. And third, what this means for your property buying strategy heading into 2026. Whether you're a first-home buyer, an investor, or someone watching from the sidelines, this decision has implications for your next move. Let's break it down. On Wednesday, the 26th of November 2025, the Reserve Bank of New Zealand cut its benchmark official cash rate by 25 basis points to 2.25%. This matched expectations. All but 4 of the 36 economists surveyed by Reuters forecast this exact move. But the real story wasn't the cut itself. It was what came with it. The RBNZ's Monetary Policy Committee voted 5-1 in favour of the cut, with one member preferring to hold rates unchanged. That tells you something right there. Internal debate about whether cutting was even necessary. Governor Christian Hawkesby told reporters, "We have published a central projection that would be consistent with the official cash rate being on hold through the course of 2026 and one where we feel the risks are balanced." The accompanying monetary policy statement said, "Future moves in the OCR will depend on how the outlook for medium-term inflation and the economy evolve. That's central bank speak for, don't expect much more from us." Nick Tuffley, chief economist at ASB Bank, said the door to further easing is not as wide as many would have expected. He added that a further cut can only be expected if the economy underperforms. The market's reaction was immediate and dramatic. The New Zealand dollar rallied 1.0% to 0.5682, the highest in over a week. Two-year interest rate swaps rose 8 basis points to 2.6653%. And the probability of another rate cut was slashed from just over 50% to 22% in a single day. Imre Speiser, a strategist at Westpac Banking Corp, said, "The market's initial reactions are warranted and should hold." So why did markets interpret this as such a hawkish signal? The RBNZ's forward guidance is crystal clear. They're forecasting the cash rate at 2.20% in the first quarter of 2026, implying just a 20% chance of another cut. By the end of 2026, they see it at 2.65%. Compare that to their August forecasts, and the shift is obvious. This is lower than previously expected, yes, but the path suggests the door to further easing has been virtually shut. The committee noted that whilst significant excess capacity in the economy argued for Wednesday's rate cut, they also placed particular emphasis on upside risks to inflation and output. Annual inflation increased to 3% in the third quarter. That's at the top of their 1% to 3% target band. The central bank expects spare capacity in the economy to help drive it lower to around 2% by mid-2026. But here's the key phrase in their statement. The committee noted that a reduction in the OCR would help to underpin consumer and business confidence and lean against the risk that the economy recovers more slowly than needed to meet the inflation objective. Lean against the risk. That's defensive language. They're not saying the economy is definitely going to underperform. They're saying they want to guard against that possibility. The statement also said, risks to the inflation outlook are balanced, not skewed to the downside. Balanced. That means they see equal chance of inflation being higher or lower than expected. Governor Hawkesby added, if the OCR was to change over the next 3 to 6 months, it might be more likely to go down than up. Notice the hedging there. Might be more likely, not will definitely go down. Doug Steele at BNZ sums it up. The hurdle to further action does look significant. To understand why this November decision is so significant, we need to rewind to October. On the 9th of October 2025, the RBNZ delivered a shock to markets, a 50 basis point cut, taking the OCR to 2.5%. This was the biggest single reduction in the easing cycle that began in August 2024. It wasn't completely unexpected. 11 of 26 economists surveyed by Reuters had picked a 50 basis point reduction. But 15 expected just 25 basis points. The decision came with a dovish statement. The committee remains open to further reductions in the OCR as required for inflation to settle sustainably near the 2% target midpoint in the medium term. The New Zealand dollar tumbled to 6-month lows, losing 0.9% to $0.5745. 2-year interest rate swaps fell from 2.6194% to 2.5251%. Markets immediately priced in a further 25 basis point cut and ascribed a 60% chance of a 2.00% terminal cash rate. This was the RBNZ signaling serious concern about the state of the economy, and they had good reason. New Zealand's economy had contracted by 0.9% in the second quarter, a shock result that fueled bets of steeper rate cuts. The economy had contracted in 3 of the last 5 quarters. Growth remains weak despite steady monetary stimulus, undermined by low confidence and a housing market in the doldrums. Prime Minister Christopher Luxon's popularity had taken a sharp hit as the economic recovery he and his party campaigned on failed to eventuate. A Taxpayers Union Curia poll released the day of the October cut found that the current government wouldn't have enough seats to govern if an election was held then. Luxon had said publicly he'd like to see the cash rate lower to shake off economic torpor. Business confidence was worsening. Households were in a depressed mood, fretting about the rising cost of living and scarcity of jobs. Finance Minister Nicola Willis welcomed the October cut, saying it was good news for growth, jobs and investment, adding, "We know many New Zealanders are still doing it tough." ASB Chief Economist Nick Tuffley said at the time, "The RBNZ's decision signals that the likelihood of inflation pressures being weaker than previously anticipated carried more weight than waiting to see how quickly the economy rebounds." Let's zoom out and look at the full picture of what the RBNZ has delivered. Since August 2024, the Reserve Bank has cut rates by 325 basis points. That's 3.25 percentage points in just 16 months. They've paused just once in 10 meetings over that period. This makes the RBNZ one of the most aggressive rate cutters among its peers. Compare that to the US Federal Reserve, which has delivered 150 points of reductions since September 2024. Or the Reserve Bank of Australia, which has cut by only 75 points. Why so aggressive? Because the RBNZ was also aggressive on the way up. As a global frontrunner in withdrawing pandemic-era stimulus, the RBNZ lifted rates 525 basis points between October 2021 and September 2023 to curb inflation, the most aggressive tightening since the official cash rate was introduced in 1999. Those punishing borrowing costs slammed the brakes on demand and tipped the economy into recession last year. The housing market crashed, consumer confidence collapsed, business investment dried up. Some economists and critics blame the central bank's rapid-fire tightening and delay in embarking on rate cuts for the prolonged economic gloom. But the RBNZ's mandate is clear: maintain price stability. And when inflation hits 7.3% in mid-2022, well above their 1% to 3% target band, they had no choice but to act aggressively. Now, with inflation back within the target band at 3%, they have the leeway to cut, and they've used it. The question is, have they done enough? The RBNZ expects the economy to have grown a modest 0.4% in the third quarter and expand 0.7% in the fourth quarter. They're forecasting economic activity was weak over mid-2025, but is picking up as lower interest rates encourage household spending. They expect GDP will grow an annual average 2.8% in the 12 months through March 2027, from just 0.5% in the period through March 2026. That's a significant acceleration, but it depends on lower interest rates flowing through to actual spending and investment decisions. Despite 325 basis points of rate cuts, growth remains weak. Why isn't the stimulus working as expected? Several factors are at play. First, confidence. Both consumer and business confidence remain low. People are still worried about job security, the cost of living, and economic uncertainty. Lower rates help, but they don't instantly change mindsets. Second, the housing market. House prices are down 17% nationally from their peak, with Auckland down 22.5% and Wellington down 25%. This wealth effect works both ways. When people feel poorer because their house value has fallen, they spend less. Third, global headwinds. Trading partner growth is expected to slow, partly due to US President Donald Trump's sweeping tariffs. That hits New Zealand's export-dependent economy. Fourth, unemployment. It's been rising, though the RBNZ now says the labour market is stabilising. But higher unemployment means less aggregate demand in the economy. Fifth, fiscal policy. The government's tight fiscal stance, keeping spending under control, means less stimulus from that side of the equation. The RBNZ acknowledged these challenges. Their statement noted, "A slowdown in the global economy, rising unemployment, and the government's tight fiscal stance have all added to New Zealand's woes." But they also see green shoots. The statement said, "Economic activity was weak over mid-2025, but is picking up. Lower interest rates are encouraging household spending, and the labour market is stabilising. The exchange rate has fallen, supporting exporters' incomes." The central bank's upbeat commentary may help the under-pressure Kiwi find a base. The currency has rebounded from a 7-month low against the greenback and a 12-year low against the Aussie earlier this month. So if you're a property buyer, what does all this mean for your strategy? Let's break it down into 3 scenarios: first home buyers, investors, and those waiting on the sidelines. For first home buyers, the window of opportunity may be narrowing. With the RBNZ signalling the end of rate cuts, mortgage rates are unlikely to fall much further from here. In fact, they could start rising if banks price in a more stable rate environment. House prices are down 17% nationally from the peak. Affordability has improved dramatically. We've discussed in previous videos how the house price to income ratio is at a decade low. If you've been waiting for lower rates before buying, this is probably as good as it gets. Waiting for rates to fall further is now a low probability bet. The risk of waiting is that prices stabilize or start rising as other buyers realize rates have bottomed. Remember, Markets are forward-looking. Buyers don't wait for official confirmation, they act on expectations. For investors, the picture is more nuanced. Rental yields have improved as house prices fell and rents remained relatively stable. Lower mortgage rates improve cash flow on rental properties. But the RBNZ's hawkish signal means you shouldn't be banking on continued rate decreases to improve your position. What you see now is likely what you'll get for at least the next year. The advantage is that first home buyers may start absorbing more of the available stock, reducing competition for investors. But the flip side is that if property demand picks up broadly, prices could stabilize faster than expected. For those waiting on the sidelines, if you've been waiting for house prices to fall further, the calculus is changing. With rates unlikely to drop much more and the economy showing signs of picking up, the downward pressure on prices is easing. Yes, prices fell 0.2% in August and 0.6% for 2025 so far. But as Kelvin Davidson from Catality points out, the market is tracking sideways now, not crashing. The RBNZ expects economic growth to accelerate in 2026. If that happens, and if labour market conditions improve as expected, demand for housing will pick up. That could stabilise or even lift prices. The risk of waiting is that you miss the bottom by trying to time it perfectly. So what should property buyers be watching as we head into 2026? First, watch inflation data. If inflation stays sticky around 3% or ticks higher, the RBNZ won't cut rates further. If it falls faster than expected toward 2%, there's a slim chance of one more cut. But based on their November guidance, the bar is high. Second, watch unemployment. The RBNZ says the labour market is stabilising. If unemployment keeps rising, that could force their hand on another cut. But if it stabilises or falls, rates are likely on hold. Third, watch house price data. If prices stabilise in the next few months, that signals the bottom may be in. If they keep falling through summer, there may be a bit more time to wait. Fourth, watch mortgage rates. These don't move in perfect lockstep with the OCR. Banks have their own funding costs and margin considerations. If wholesale rates rise, mortgage rates could tick up even if the OCR stays flat. Fifth, watch the new governor. Anna Bremen takes over from Christian Hawkesby in December 2025. Her first monetary policy meeting is in February 2026. That will give us insight into whether her approach differs from Hawkesby's. Bloomberg economics economist James McIntyre suggests there could be one last confidence-boosting cut in the first quarter of 2026 before wrapping up the easing cycle. But he acknowledges that depends on economic conditions. Zoe Wallace, investment strategist at Forsyth Barr, is retaining her terminal rate forecast at 2.25% for now, but says there is a chance that further easing beyond that level could be on the cards if inflation proves well contained and the economy fails to fire up convincingly in coming months. The consensus view? The easing cycle is done, or very close to done. Let's bring this all together. The Reserve Bank of New Zealand cut rates by 25 basis points to 2.25% on 26 November 2025, but the accompanying message was hawkish. The easing cycle is essentially over. Markets reacted immediately, with the New Zealand dollar jumping 1%, interest rate swaps rising, and the probability of another cut plummeting from 50% to 22%. The RBNZ has delivered 325 basis points of cuts since August 2024, one of the most aggressive easing cycles globally. But with inflation at 3% and the economy showing signs of picking up, their signaling rates will likely stay on hold through 2026. For property buyers, this changes the equation. If you've been waiting for rates to fall further before buying, this is probably as low as they're going. Affordability has improved dramatically. Prices are down 17% from the peak, and mortgage rates are at multi-year lows. But the window may be narrowing. With economic growth expected to accelerate in 2026, demand for housing could pick up, stabilizing or lifting prices. The takeaway for first home buyers: this may be your moment. The combination of lower prices, lower rates, and improved affordability won't last forever. For investors, cash flow is better, yields have improved, but don't bank on further rate cuts to improve your position. For those on the sidelines, the risk of waiting may now outweigh the potential benefit of slightly lower prices. The Reserve Bank has spoken. The easing cycle is over or very close to it. What you do next depends on your individual circumstances, but the window of maximum opportunity may be closing. If you found this analysis helpful, hit that like button and subscribe to Kiwi Property Reports for in-depth coverage of New Zealand's property market and monetary policy developments. Drop a comment below. Do you think now is the right time to buy, or are you still waiting? What's your strategy heading into 2026? Thanks for watching. I'll see you in the next report.